In this video, I'm going to walk you through a highly effective liquidity-based strategy. This is a method widely used by experienced traders, but I'll explain in a way that's simple enough for complete beginners to understand. So if you've ever wanted to learn how more advanced traders approach the market, you're in the right place. Let's get started. This strategy is built around one main idea: liquidity. But what does liquidity actually mean? In simple terms, liquidity refers to areas in the market where orders are waiting to be filled. Let's make this easier to understand with an example. Imagine you're looking at a chart and you decide to place a buy order at a specific price. By doing that, you're adding liquidity to the market at that level. You're basically saying, I'm ready to buy at this price. The same idea applies when placing a sell order. You're saying, I'm ready to sell at this level, which also adds liquidity to the market. In reality, liquidity exists at almost every price level because traders all over the world are constantly placing orders. These participants include individual traders, institutions, and large financial players. So at any given price, there are always buyers and sellers interacting with each other. That interaction is what keeps the market moving. However, not all price levels have the same amount of liquidity. Some areas attract more attention than others. For example, imagine support level where price has reacted multiple times. When price approaches that level again, many traders expect it to hold. As a result, they place buy trades near that level and often set their stop loss just below it. You may have noticed what happens next. Instead of bouncing immediately, price dips slightly below the level, triggers those stop losses, and then reverses upward. This can be confusing if you're not familiar with what's happening behind the scenes. The reason for this behavior is that larger market participants often aim for those areas where many stop orders are placed. These zones contain liquidity that can be used to enter larger positions. Once that liquidity is reached, price can move in the opposite direction. That's why you'll often see price briefly move past key levels before reversing. The goal of this strategy is to help you understand that behavior, so you can approach the market more effectively instead of getting caught on the wrong side of the move. This method tends to work best on lower time frames, such as a 5-minute to 15-minute charts, and it can be applied to different markets like Forex, crypto, or stocks. Now, to keep things simple, we'll break everything down into 4 clear steps. Each step builds on the previous one, so it's important to follow them in order. Let's begin with step 1. Step 1 is identifying a break of structure. Before we do that, we need to understand how trends behave. Markets generally move in 2 directions, upward or downward. In an uptrend, price doesn't move in a straight line. Instead, it creates a pattern of higher highs and higher lows. In a downtrend, the opposite happens, with price forming lower highs and lower lows. A break of structure occurs when this pattern is disrupted. In an uptrend, this happens when price moves above a previous high and creates a new high. In a downtrend, it happens when price drops below a previous low and forms a new low. When analyzing a chart, you should wait for a candle to fully close beyond the previous level to confirm the break. A simple wick is not enough. Once you've identified a valid break of structure, you can move on to step 2. Step 2 is locating a supply or demand zone. These zones represent areas where strong buying or selling activity previously occurred, leading to a noticeable move in price. To find them, start from the break of structure and trace back to where the strong move began. If the move was upward, the area before that move is considered a demand zone. If the move was downward, that area becomes a supply zone. To mark the zone, highlight the final candle before the strong movement. This area becomes important for potential future reactions. Now, moving on to step 3, which is identifying liquidity levels. This is one of the most important parts of the strategy. Liquidity levels are areas where many stop-loss orders tend to gather. These often form around clear patterns, such as double bottoms, triple bottoms, or repeated rejections at the same level. When a level looks obvious, many traders place trades there and position their stop-loss just beyond it. This creates a cluster of liquidity. What we're looking for is a liquidity level that sits near our supply or demand zone. In a bullish setup, price may dip below a visible level, collect liquidity, and then move upward from the demand zone. That upward move can present a potential buying opportunity. In a bearish setup, price may move above a visible level gather liquidity, and then move downward from the supply zone, creating a potential selling opportunity. Now for the final step, entering the trade. A common approach is to place a limit order at the zone you've identified. For example, in a bullish setup, you can place a buy limit at the demand zone, set a stop loss just below it, and aim for a target that is at least twice the size of your risk. Alternatively, some traders choose to target previous highs or lows depending on the situation. Using a limit order allows you to plan your trade in advance without needing to watch the chart constantly. You simply set your levels and let the market come to you. In many cases, price may briefly move beyond the liquidity level, enter your zone, and then reverse toward your target. At first, this strategy might seem complex because it involves multiple conditions, but with practice, it becomes much easier to recognize these patterns. In the end, it's about understanding how price behaves around key areas rather than trying to predict exact movements. Instead of trying to chase the exact price movement on a chart, focus on the rules that create the pattern. For example, in a triangle pattern, you don't need to predict each price point. You just need to identify the converging trend lines. The same principle applies to our liquidity strategy. Don't look for a perfect price move. Instead, focus on the key elements, a liquidity level forming near a supply or demand zone. Understanding these rules is far more important than memorizing the price sequence. Let's go through another example. Step 1 is spotting a break of structure. Looking at this chart, price is forming lower highs and lower lows, showing a clear downtrend. Here, we can see a break of structure as price drops below a previous low, forming a new lower low. Another break of structure can be seen slightly later when price breaks yet another low. Step 2 is identifying the supply or demand zone. Since this is a downtrend, we're focusing on a supply zone. Take the most recent break of structure, then find the starting point just before the sharp move down that led to that break. Mark this area as your supply zone. Step 3 is locating a liquidity level below the supply zone. Multiple wicks at this level indicate liquidity, making it a target for a sweep. With a supply zone and liquidity level aligned, we have a valid liquidity setup. Step 4 is executing the trade. In a downtrend, we look to short. Place a limit sell order at the bottom of the supply zone. Set a stop loss slightly above, and target the previous lows for profit. In this example, price sweeps the liquidity, enters our supply zone, and then moves down to the target, creating a clean trade. This strategy works well on lower time frames like the 5 or 15-minute chart and can be applied to Forex, crypto, or stocks. Even this basic setup can provide consistent trading opportunities. Now, let's move to an advanced version of the strategy. The advanced setup starts the same way. Identify a break of structure to mark supply or demand zone from the initial sharp move. The difference is in the liquidity level. Instead of a typical double or triple bottom, the liquidity is formed by a second minor zone above or below the main zone. How do we distinguish major versus minor zones? Look at the break of structure that formed them. Large swings indicate a major zone, while small, short-term moves indicate a minor zone. The ideal setup is a minor zone position near a major zone, which becomes our liquidity level. For a bullish example, price forms higher highs and higher lows. Identify the first break of structure and mark the major demand zone. Next, spot a second break of structure from a smaller swing to mark the minor demand zone above it. When price sweeps the minor zone and bounces off the major zone, we place a limit buy at the top of the major zone, a stop loss slightly below, and a target at previous highs. The trade plays out perfectly as price reacts at the minor zone, then moves upward to our target. For a bearish example, price forms lower highs and lower lows. Mark a supply zone from the larger break of structure and a minor supply zone from a smaller swing. Just below it, place a limit sell at the bottom of the major zone. Set a stop loss above and target previous lows. Price interacts with the minor zone, sweeps liquidity, enters our major zone, and then moves down to our target. Another clean trade. This completes the full liquidity strategy tutorial. By understanding these setups, you can trade with more confidence and spot high probability opportunities.